today let's try and understand what is insurance and also how it works. So let's assume that you're facing a risk. The risk could be on your motor vehicle. You have the risk that it could be stolen, or the risk that you could be involved in an accident and your motor vehicle would get destroyed. You also have other risks like the risk on your property. Your property could burn down. You also have risks to your health. Yeah, you could get sick, and you might not have enough money at hand to actually take care of yourself or to pay for your medical bills. So let's say your risk is worth 2 million Kenya shillings. Let's say that's the value of your motor vehicle, for example. So the insurance company will calculate a premium for you of, let's say, 60 or 70,000 to cover you for that risk of 2 million Kenya shillings. So what that means is that when you pay the 70,000 shillings and your motor vehicle gets lost, the insurance company will replace it for you. And if you're involved in an accident and your vehicle is actually destroyed, the insurance company will again help you to repair that motor vehicle. So you will pay a premium for that. That premium could be monthly or it could be calculated yearly, depending with the type of policy that you have taken up. And I know at this point you're wondering, if I'm paying 70,000 annually, but if anything happens to me, I'll get paid 2 million Kenya shillings. Where is the insurance company getting the extra amount to pay for my motor vehicle, even though I paid a premium of only 70,000 shillings? Well, what the company does, it sells the same policy to a large pool of people who actually share the same risk. So you'll find an insurance company will calculate the probability of a risk happening. For example, the probability of houses burning down in a certain area. If you're Kenyan, you, for example, understand that it is very difficult for you to insure your property for fire in areas around Gikomba. This is because the probability of actually a fire happening in Gikomba is very high. And that makes it very unprofitable for a company to offer that cover there. But in a general population, you will find that a company will be able to calculate the probability of a certain risk happening, and because there are many people in that pool, it comes up with a rate which you pay as premium, and that rate is calculated in such a way that it will be able to cover the risk and also maybe give the company some profits, because again, it's a business. So in the rare case that an insurance company cannot pay for the claims because again, maybe something happened like a storm and a lot of motor vehicles got destroyed, and the premiums that you actually contributed are not enough to pay for that damage that occurred, an insurance company takes up what you call a reinsurance policy. So there are companies called reinsurance company. These are insurance companies that insure insurance companies. So they are known as reinsurance companies. So this will help the company to pay for claims that they could not, because maybe something like a storm happened, or like I said, something that could simply not be handled by the company. So that is basically how an insurance policy works. So if you have a claim, for example, if you have a motor claim, you report it to your company, and then your company will send in investigators. So these are the people coming in to actually verify that what you're saying actually happened. So you find that there are a lot of cases where people tend to commit fraud with insurance policies. So insurance companies need to verify that that is an actual legitimate claim before they actually make payments for you. But with that, you basically have a simple idea of how an insurance policy or an insurance company does the Let's work.